Give me the top 3 takeaways, biggest mistakes entrepreneurs, small business owners should watch for taxes.
Well, the biggest mistake is not keeping track of your books throughout the year.
Okay.
A lot of the times what happens is tax time comes, oh no, I have to give everything to my accountant, throw everything in this box, bang it all into a spreadsheet. Invariably, things are missed.
Yeah.
So now you're missing out on tax deductions and you're paying more tax.
Welcome everyone, and welcome to another episode of Ryan Out Loud. And I'm happy to have Caitlin Lawrence here from the firm TaxForce here in Sarnia, Lambton. And we're going to learn more about accounting and some best practices really geared towards those entrepreneurs out there. And hopefully we learn something here today. Welcome, Caitlin. Thanks for coming today. I'm excited to go over this with you.
Thanks for having me, Sean. Super pumped to be here.
Awesome. You know what? Let's start with a question. Why should I hire an accountant? And then what's the big difference between an accountant and one of those tax places that we see pop up every season?
Okay, so that's a really great question and one we get all the time. An accountant at a firm, they've spent quite a bit of time in school studying the rules. They've worked really hard to get where they are, and they're going to work with you as the client to get to know you. Those little firms that you see popping up during tax season, or even the tax software that you can buy, they don't get to know you as a person. So they don't know what's important to you. They can't do the tax planning for you. Their goal is to get you through tax season as fast as you can.
So a big difference here, what I'm hearing you say is you spent, 5, 6, 7, 10 years in school?
I spent 10 years in school.
Wow, okay. And then so the person at those tax places, they spend maybe a month, 2 weeks, do a quick course. They're very seasonal workers.
That's correct.
Okay.
And a lot of them specialize only in specific areas, so some will be specifically just basic T4 slip returns. Some will be small business returns. So they don't really have a broad scope of knowledge, whereas going to someone at a big accounting firm, they'll have a thorough understanding of all the rules that might be applicable to T4 small business.
So we're going to gear most of this today, like entrepreneurs, small business, stuff like that.
Yeah.
So especially if you own a business or you're a small business owner, have any complications to your tax return whatsoever, like own rental properties or anything, 100% you should be going to an accountant. It's one of those things where it might cost you a couple extra bucks.
Yeah.
But it actually saves you money probably because the amount of taxes you're not going to pay or save or things you shouldn't be paying that you are.
Yeah, that's absolutely correct. Because we get to know you as the client, we think maybe there's a little extra deduction we can claim here, something we can do there just to get you through.
So hiring an accountant actually, it's not really a cost, it's an investment.
Exactly.
That's probably the best way to look at it. So let's go back to taxes. I'm a small business owner. I'm an entrepreneur. What records should I be keeping? So
really, as a small business, you should be keeping all your records. You should be keeping all your receipts. You should be documenting it. I mean, I certainly get handed boxes of receipts and I go through them. We do our best to coach our clients at the TaxForce to get through things a little bit smoother by using a program we like to promote called Dext. And for a little bit more complicated, if you want to keep track of your books online, we use QuickBooks Online. All of these are totally automated these days. I mean, Dext, you just take a picture of your receipt and you're done. It categorizes it for you. And then at the end of the year, we just get everything in a spreadsheet.
So let's go back to the receipt. So should we write something on those receipts at all times? To kind of give an explanation what it is, or?
It's better to do that, particularly if it doesn't say your business name on it. One thing that the CRA is really picky about, if it doesn't have your business name on it, then they don't like to use it. So if you write on it, your business and what it was for, especially if it's a meal or something like that, I was out at lunch talking with Sean about business.
So for example, I'm using my personal credit card. I go out for lunch and I'm using it as a tax deduction because it was a client or business partner. Definitely write the name of that business partner, what you were doing there, because it's not going to be on your company's credit card.
That's correct.
Okay, cool. And how long are we got to keep these records for? So how long am I keeping all the receipts in my boxes and everything?
CRA says 7 years.
Okay.
That's how long you should be keeping them for. Technically, once it's past the 4 years, they can't go back further than that, but CRA states 7 years is what you should be keeping.
So if you get audited, how far do they go back?
So if you get audited, they usually go back 4 years. Unless something comes up, then they can go back up to 7.
So that's why they see keep to 7 just in case. So what are some best practices for people to prepare for taxes so they don't show up with a shoebox and say, here you go, have fun with the mess?
Well, really the best practice is to keep track of your books as you're going along through the year. You know, depending on your volume of transactions, you want to sit down on a weekly, monthly basis and go through everything, whether you use Excel spreadsheet, Dex, QuickBooks Online, just make sure you're up to date. Now, there's also a benefit to this where if you are actually a numbers person and you want to look at where you're sitting, your income, your expenses, then you can see what your profit is and maybe keep check of your expenses throughout the year so you're making smarter business decisions.
And I think that's one of the biggest mistakes I think anyone makes, like personally or a business, is they do their tax return, they're usually done halfway through the year, and they go, I'm going to spend less on this year, but it's almost too late because they're already halfway through the year. Like personally, we do a P&L every month by the 6th day of the following month, so we can make adjustments in our business. Like, okay, we spent way too much on that last month. We're on a budget for this month for that category. So it's really doing it little bits as you go and keeping up with it. If it's through a spreadsheet, or you guys have bookkeeping services that can do that for people probably too.
Yeah, we do actually.
So would you say, like, for a standpoint, you're like, I don't want to hire a bookkeeper and do that every month. Do you think, does it cost much extra? Like, I'm not asking you to quote any numbers, but from a perspective of any of your small business owners, to have a bookkeeper do it all year compared to you trying to put it all together as a mess at the end of the year?
So there's an advantage to having it done throughout the year. Is you're saving yourself time. You know, when you consider that your time is your most valuable asset, you're saving that. We kind of teeter between hiring a bookkeeper and doing it yourself. Personally, having a bookkeeper means you're not in control of your books. You don't see what's going on every year. But if you're the kind of person that's like, I absolutely hate my books, I'm never going to do them, and you do it at the end of the year, hiring a bookkeeper does make sense. So you do save money in the long run. You know, it seems maybe up front you're paying for the services, but in the long run you're saving money because you have a better understanding of where your books are, and the bookkeeper or you can actually notice areas where you're maybe overspending, or on the opposite side, maybe you're not charging enough, and so then you can start raising your sales.
So again, it's just what we talked about before. It's another investment into your business. So let's talk about really quick, what are some of the biggest mistakes you people see people do when it comes to tax time? Every year you go through these entrepreneurs, every time you see that, you're like, oh, not again. They didn't do this. So what are, give me the top 3 takeaways, biggest mistakes entrepreneurs, small business owners should watch for taxes?
Well, the biggest mistake is not keeping track of your books throughout the year.
Okay.
A lot of the times what happens is tax time comes, oh no, I have to give everything to my accountant, throw everything in this box, bang it all into a spreadsheet. Invariably, things are missed.
Yeah.
So now you're missing out on tax deductions and you're paying more tax. So that's probably the first mistake. The second mistake is waiting until the very end. And while we do our best to kind of manage our time and get everything done in a time-efficient way, accountants are tired in April. Don't come to us in April with a box of receipts and say, go through this.
So as a small business owner, you're self-employed, when's the due date for taxes?
So the due date to file your taxes as a small business is June 15th. Okay. But if you owe money, April 30th.
Gotcha. So the biggest mistake, one of your mistakes is people wait to the last minute.
Exactly.
Okay, so what's your third biggest mistake?
The third mistake is not preparing for a tax bill. So throughout the year, my personal recommendation is let's take a look at what your average tax rate is. So if your average tax rate is 20%, and then I just say, okay, 20% of every dollar, put it in another account that you have no access to. This way, when tax time comes around, you're fully prepared to pay this bill.
Stop you. So when you say tax bill, it's not the accountant bill, it's the CRA bill.
Yeah, when the CRA bill's handed to you.
Everyone's not prepared for my bill. It's like, no, so it's the CRA bill taxes. Okay, sorry, keep going.
Yeah, so you've got this other savings account that you haven't touched. You've got 20% of every dollar that you've earned in there. So let's say you earned, $100K. You've got $20,000 sitting in this account. Chances are you're not going to have to pay $20,000. Reason is because there's still all these deductions that get applied. So how great is this? You've got $20,000 sitting in the bank. I say, okay, you owe $10,000. Now you've got $10,000 to go and spend how you want. But a lot of people aren't prepared for that. So then I hand them this bill for $10,000. They don't have any money to pay it with. Now they're paying CRA interest, which is not tax deductible.
No, not at all. And you know what? I've learned that myself, and that's why I started doing taxes every month, essentially, is that's what we're doing. We're paying them on a monthly basis or quarterly basis. But I think one of the best lessons I ever learned from that was every dollar I earned, it would get divided into 3 different accounts. Taxes, savings, operations of running the business. So you have that money, and then also, putting away the money in the savings as well. So if you need to pull it out for that. So now we're talking about separate accounts. Is if you're a small business owner, there's a good chance you're charging HST.
Right.
And HST is never your money.
No.
You're just holding it for the government.
Right.
So let's talk about HST best practices really quick.
So same with personal tax. I say, just keep the tax.
Yeah.
Don't spend it. Put it in another account. Open up a separate account just for HST and personal tax, or open up 2 accounts, one for HST, one for personal tax. Don't ever touch this account. Invest it. Earn some interest on it.
And you can pay HST quarterly or yearly, right? Depending on.
Well, actually, you can do monthly,
Yeah.
quarterly, or annually. It really depends on your business. Sometimes the CRA will make you be quarterly or monthly based on your volume of sales.
Yeah.
Typically, small business clients have the option to choose whichever reporting period they want. Monthly is nice if you're worried about cash flow. Same with quarterly. It's a little bit of a better check throughout the year. A lot of people are just annually, and that's just fine.
So, but going to like the HST, I always look at putting things in place to help with the business. So like if you went to a quarterly HST, it also forced you to do your books quarterly.
Yeah.
So it'd be kind of like 2 birds with 1 stone. You'd be making sure you protect yourself, not those giant tax bills, but also then you got to get those books in so you can get those deductions for the HST. So it could really work well with someone that maybe does yearly to go down to quarterly or go up to quarterly so that they do their stuff more there.
It does, as long as you're going to be diligent and do it. Because if you miss your filing, not only now are you a late filer, so you're going to get a penalty for that, but they'll charge you interest on your overdue account.
I love taxes. No, I'm just kidding. So speaking of that, putting money aside, how much for every dollar someone makes, small business owner, how much should they put aside for taxes?
It really depends on what their tax bracket is. So if you're in the first tax bracket, 20%.
Okay.
If you're in the second one, maybe 25 to 30%. I mean, the highest tax bracket in Canada is like 55%. But I mean, that's if you're making over $200K a year, at which point we'd maybe talk about incorporating your small business.
Okay, so let's go back. So first tax bracket you said is 15%?
Well, it's 15% federally and then 5% provincially.
20%. And what income level could you be up to? If you know that off the top of your head.
It changes every year. For 2021, I believe it's just under 50.
So if you make under 50,000 net, not gross, you'll be taxed at 20%.
Well, actually taxable, not net.
Okay, gotcha. What's the difference between taxable and net?
So taxable income, so they'll have your net income.
Yeah.
Which is kind of before RSP deductions and those kinds of things.
Okay.
So special deductions. And then those get deducted off your net to arrive at the taxable. So the net income matters for things like your child benefit or your Trillium benefit, for example, will be based on your net income, not your taxable income.
Oh, interesting. Wow. And then the next tax bracket you said was 25%, 30%?
Something like that. Yeah.
And then what's that next range, roughly?
The second bracket, I believe, is just under 100.
So 50 to 100 taxable income, put you at around 30%?
Yeah.
Give or take. Yeah. And then after that, it just keeps going up.
It does.
And then, so RSPs, let's talk about that. That's interesting you brought that up, because that is there a magic number for RSPs that people figure out calculation? What's some best tax practices for that?
It really depends on where you are, what your goals are, what you expect your future income to look like. And that's something that we at the TaxForce really specialize in doing, is RSP planning. It's one of my favorite parts of tax season, actually. And I say, what are your goals? Where do you think you're going to be income-wise? Like maybe this year your income's really high and next year it's going to go down. So let's buy some RSPs. Typically, I work to get you down to the top of the previous bracket. So I'll say, okay, well, your income is, let's say 55. You want to get down to the first bracket. Let's put, 5, 6K in RSPs, and that'll get you down to that first bracket. Actually, a conversation that I had with a colleague yesterday about RSPs, because something that would relate to you is the first-time home buyer's RSP plan, right?
Yeah.
So a lot of clients will say, oh, I'm saving for my first home through RSPs. That's great. I love that idea. But if you're in the first bracket and you're claiming the tax deduction, you're not actually really saving any tax. The reason is you're going to get the deduction when you're in the lowest bracket, and likely you'll take your RSPs out when you're in the lowest bracket when you're older.
Yeah.
So I said, look, TFSA, the money goes in taxed, but it earns interest tax-free. Put the money in, increase it by investing, earn some interest, dividends, whatever. Take it out, transfer it to your RSP.
Yeah.
So then you get the deduction then, but then you've earned all this tax-free income.
Might as well. And I think this really goes back to my original question, is why I should hire an accountant over, one of those places that are more seasonal and stuff like that is, this is about relationship building.
Exactly.
Getting to know their families and knowing parts about them and how they operate and getting to know them and going like, hey, like you had a kid last year and this, and this, or you have a grandkid now, or, we have some tax planning here for that. Yeah. And that really goes down to, like we're talking about the investment and the money you save and tax preparing and being prepared as a business owner is huge. Yeah.
At the TaxForce specifically, we really take a lot of time to get to know our clients. My associate, I can say this client, like, oh, I know them. They live here. They have this many kids, even this many dogs. He knows all about them. Yeah. I'm getting to that point now. I've been there for 7 years, but I really love getting to know my clients. And, since having my child in November, I even send them pictures and they love it.
It's a different perspective now.
Once
you have kids and you're in that world as well.
Yeah.
So let's go to investment properties and let's talk a little bit about capital gains. Obviously, let's not go too high level on it. Let's just give people like a broad overview. And it's a question whenever I have a client that is looking to sell an investment property. Usually the first question I ask them is, have you talked to your accountant yet?
Okay.
Just for proper, like, should I sell it this year or next year or, stuff like that. So let's go over, you have an investment property, you've owned it for a few years, you've owned it forever, whatever, you're thinking of selling it. What are some questions, some research you should be doing before you sell that investment property?
Well, the first thing we like to talk about is what else has happened this year. Has your income been unexplainably high this year for whatever reason? Yeah. Maybe this isn't the year to sell it. Maybe wait until next year. Sometimes we have clients who have 3 rental properties. They want to sell them all in 1 year. Maybe that's not the year to do that. Some things you want to be keeping track of when you go to sell your rental property are, what did you originally pay in terms of legal fees, there wouldn't be realtor commissions on the purchase, but legal fees, closing costs, all that kind of stuff gets deducted off, the sale price. So how capital gains works, you sell it for X amount, you subtract what you paid to sell it, then you subtract what you paid to buy it, and that includes closing costs and all that. So you want to make sure you have all of that stuff.
So as together. A person that owns it, let's say a personal person owns it, on average, we'll do a range. What would someone expect to pay in capital gains?
Well, again, it depends on your level of income, right?
Yeah.
So currently, 50% of capital gains are taxable in Canada. So, you sell a property, you make $100,000, you pay tax on $50,000. What you're going to pay is really dependent on what your income is. If your income's $100,000 and then you have $50,000 of capital gains, you're paying tax on $150,000. You can offset that by maybe buying RSPs. So some research to do potentially would be talk to your accountant and see what your RSP deduction limit is, and then maybe look at doing that. You could look at doing some donations, working with your accountant maybe before December 31st so that you have some planning.
So having a plan in place.
Yeah.
So, a lot of people want to sell investment properties because they need cash. They need some money to do something. And a lot of times I see people doing is, why not refinance the property, pull out some equity on like a secured line or a mortgage, and then when they take that money in, that's not taxable, correct?
The refinanced?
Yeah.
No, that's not taxable. The problem is, so let's say you refinance your rental property and you pull the cash out to use it personally. It makes the lines of interest deductibility really blurred.
Okay.
So the CRA allows you to deduct interest on your rental property because it's used to generate income. But if you're using a portion of the mortgage to now, finance your own investments that are not part of the rental property, the CRA says, hey, hold up. Why are you deducting interest on this when it's not used for this? So that's something you really want to be careful of. And I think some banks will actually do a split for you. So if that's something you're looking at doing, make sure you talk to your bank about getting the split so you have a clear line of what's deductible against the rental.
So it's a little blurry on the deductions, but people could pull the money out and not get taxed on it by refinancing.
Yeah, okay. They could.
Just an example, because a lot of people, I need the money. Like I had a client a little while ago, and she's like, I want to sell my rental property. I need the money. I want to pay off some student debt. Mm-hmm. And I'm like, well, why don't you just refinance it, pay off the student debt?
Yeah.
And, you know what I mean? And she's like, but I'll get done. Like, you won't get, so she doesn't get taxed on that then.
Well, no, because it's not income to her. She's just got more debt.
Exactly.
She's financing debt with debt.
But it's
a lower rate debt.
Yeah, it's an interesting way to do it sometimes. And then what about if you're a corp? Say you're incorporating on these investment properties for capital gains.
Yeah, so actually incorporating for rental properties does make a lot of sense depending on what tax bracket you're in and what kind of goals you have, how many rental properties you're looking at buying. I've talked about myself with my husband, actually. So when you own a corporation, the non-taxable portion of the capital gains, it's not like when you're personal and you just get to keep it. It's sitting in the corporation. Yeah. But the CRA has a specific way that you can pull these funds tax-free. And it's called the capital dividend account. So every time you sell something for a capital gain or a capital loss, it gets put into this account. So capital gains, add to it, capital losses, subtract from it. But then what you can do is pay yourself a dividend, a capital dividend, and it's tax-free. There is a little bit of extra work involved in that. You have to file some elections. So it's something you certainly will want to work with your accountant on.
Yes.
But it is something that is available to you to pull out money in a tax-free way from your corporation on your capital gains.
So it's different every time. Talk to a professional. They'll dive deep with it. So as we're wrapping up here is, say you're a newer entrepreneur. I'm getting into business for myself. What is the top 3 things you recommend that I do when getting started in business so I'm more successful when it comes to the accounting, the tax side?
Well, the first thing that I would suggest is engage an accountant before you get into business.
Okay.
Because they often have ideas of, how you can better structure things in terms of your bank side, keeping things separate, pricing even. Like I love to talk to my clients about optimal pricing strategies and how they can make more money. So engage an accountant, first one. Second one, get set up with a proper bookkeeping system. We like to use QuickBooks Online.
Yeah.
And actually included in our services, we'll sit down with you and train you on how to use it. So, understanding your books, like we touched on earlier, is really a crucial aspect to understanding your business and the profitability of your business. So, second thing, really have a solid bookkeeping system in place.
Okay.
And the third thing I would say is keep up with your books. Again, we touched on this earlier, but keeping track of your books all the time, making sure they're up to date, and then you're not scrambling at year end, you're not missing deductions. So that way you're set up and there's no stress involved.
So you guys aren't all that scary after all.
No, we're not. We're boring most of the time.
So, accountants are here to help. They could really make or break your business journey is the best way to put it. So really engage with an accountant, get started on, have a consultation, find one that's a good fit that can grow with you and your business and really help you along the way. This has been some absolutely great information today, and I really thanks you taking your time today to share this with our viewers. And we're going to put all your contact info in the description as well, so people could reach out to you, either email or phone, and hopefully maybe you can help them.
Yeah, that sounds great. Thanks for having me.
Awesome. That's another episode of Ryan Out Loud. Thanks, everyone, and we'll catch you next time.